Think we are live, ladies and gents. Do you get the same very robotic voice that I do when I start this? You are now in listen only mode. Welcome to the webinar. Feel like now with AI and everything, all this voice gen stuff, we could have something a little bit cooler. Go to webinar if you're listening. Anyway, what we've got going on, we'll start in a few minutes, ladies and gents. Thank you for joining me for this webinar, the Multi-Playbook Method. If you were looking for something different, then this is the webinar. We're talking about trading, multi-playbook method. We're going to talk about momentum, mean reversion, scalping. Don't want to spoil stuff yet. We'll get into that in a moment. What's going on in the markets? Let's have a look. YM or Dow has just literally been in a sine wave. Get your 5-minute chart, a 1-minute chart, and just look how it's been sine waving up and down almost perfectly around the VWAP. We've had tape bombs coming out. NQ tried to, or NASDAQ tried to push up. Trump came out and said all sorts of stuff. It's the market we're in, guys. It's July. Are we starting to back off the throttle a bit? Is the volatility starting to crush? It is. It is. Would it pick up again? Maybe. But, we're at all-time highs. We are coming into the summer. We're out in summer. And market is less responsive to news than it was. So this is quite apt, this webinar, to be honest, talking about some of these things and how we judge the regime and build a kind of playbook to suit all, or not, as won't spoil stuff, or not, as the case may be. What's else been happening? So gold's down about 1%, crude's up about 1%. Bitcoin's doing nothing, still trying to break out that highs. Everyone's waiting for that breakout. We have Tesla recovering a little bit after yesterday's hammering. Elon Musk creating his new party, which the market didn't like. Copper, what I've been watching for a while, that's up 6 and a bit percent. Okay, copper. Okay, sneaky little thing. What else we got on the docket? We have, that's about it on my watch list, which I pruned right down. I did have sugar on there. So when you're watching sugar, like, hang on a second, take it, just relax, man, just relax. And while I was watching sugar, I'll justify this. There was a massive spike the other day, and I kind of have it, and I watch all this type of stuff, and I think I've got a little bit nostalgia for an old coffee trade I did many years ago, which was the same type of thing. Loads of hedge funds were net short. They came out with something. It was back then in the coffee bean. It was like a pest or a parasite or something on the coffee fruit, not the bean. Coffee aficionado expert here. Sugar has the same type of thing. There was something about the frost in Brazil, blah blah. It spiked up. I thought, oh, could we get a big squeeze? It's not done much. It's just sat there. So anyway, time to be patient, I think, ladies and gents. Time to be patient. Okay. Anything else exciting to share? There isn't much, is there? It's drifting around. It's trying. It's creeping. It's creaking. It's sitting at highs. It's oscillating. It's doing its thing. It's what the market does. It expands. It contracts. It backfills. It trends. We have to adjust and adapt. So today's probably a perfect webinar. I would like to, before we get started, I would like to read you an extract from Trading for a Living. Trading for a Living by Alexander L. There's a bit beaten up this because I bought this probably when a couple of years after I started trading. So let's say 2002, 3. This book was copyright 1993. So it's an old book. Anyway, I'll be quick. I'm not here to read you a story. I'll be quick. Talking about exiting trades here. He says, one of the worst mistakes of traders is counting money while they have an open position. Counting money ties your mind in a knot. It interferes with your ability to trade rationally. If you catch yourself counting paper profits and thinking what you can buy with them, get rid of those thoughts. If you cannot get rid of them, get rid of the position. And here's a good quote. If a beginner cashes out too early, he kicks himself for leaving money on the table. If he decides to hang on the next time, overstays a trade and loses money. Oh, he decides to hang on next time, overstays a trade and loses money. If a beginner misses a profit because of a reversal, he grabs the first profit on the next trade and may well miss a major move. The market tugs on the amateur's emotions and he jerks in response. I thought that's actually it's pretty apt for what we're going to talk about today and kind of some of the things we're going to cover. But we've all been here. We've all been here and looking at that unrealized P&L and wondering whether you should take it, wondering whether the market's going to move on a little bit more, wondering whether this is the day we're going to get a range expansion. Is it the day I should be taking quick A to B trades? Difficult to know. Now, we're going to cover some of that sort of in this webinar today, but it's always going to be there. That challenge is always going to be there, and we can never make it perfect. We can never solve it. We can get better. Hopefully you can all hear me. I'm just double checking my mic. I think it'd be good that the chat would be filling up. If you want to ask questions, you're welcome to. We'll have some time at the end for a Q&A. We'll run for about 45 minutes, do a Q&A then. Thank you. Well-being has got his thumb up there, her thumb up. Okay. Let's talk about the multi-playbook method. So a great quote from Eisenhower here. This is something I put in my daily email. In preparing for battle, I have always found that plans are useless, but planning is indispensable. Perfect quote for the markets, because what he's trying to say here is, listen, we need to plan our day, plan out the way we're going to approach the trading day. And that the very nature of doing that plan is what actually gives us the confidence to execute, even though things don't go as we expect. Sometimes they do, right? But most of the time they're not going to. Most of the time the market does what it wants to do, and you have completely misread it, or you have thought you're going to be in a rotation day and it's kind of ripped off the upside, etc. You get the point. So we don't have to be, and this is, I think, the challenge with many traders is we think that, oh, we have to have the read right, so to speak. And it's not necessarily the case. Yeah, of course, we've got to get direction right. If you're going long and the market's going lower, then, what can I say? We're going to get stopped out. But ultimately, we have to read and adjust and adapt to the regime as it shifts. Okay, so let me show I'm on here. So today, we've got this decision as traders. Now, a lot of the time, by the way, these webinars follow on from ones we've done before, last week, last month, whenever it might be. So today is kind of a little bit of a follow on from the last week's webinar. And the decision that we've kind of got as a trader is, and by the way, there's no right or wrong here. I'm not here to tell another man or woman how to trade. I'm not here to say this is exactly how you should be doing stuff. I'm just here to give you some ideas and suggestions and thoughts. And one way to kind of master the art of trading is to just say, listen, I'm just going to trade one strategy, option one. I'm going to trade one strategy, and I'm just going to wait patiently. A lot of traders struggle by trading one strategy, and then they're trading it in all sorts of environments. Today would be a perfect idea. You're trading breakout strategy on the Dow, you're just going to get smashed. Right? If you're trading mean reversion, today is perfect. If you're a breakout trader, today you sit out. If you're just a one-trick pony, so to speak, you wait patiently if you're conditioned, and it's great conditions. Sorry, it's great when you're aligned with the current market regime, but you have to be able to sit on your hands and do nothing when the market regime isn't aligned with your strategy. So, great example, if you're a breakout trader, you need to be in environments where you're getting those momentum breakouts, long side, short side, whatever it might be. And when it's not, you have to sit on your hands. And that's a struggle for many traders. And the downside is there's pros and cons to all this, right? And like I say, I'm not here to dictate one or the other. The downside of that is that you don't get as many reps. So if you're a developing trader, you're trying to improve your trading, you don't get as many repetitions out of getting involved in the market, because you might have to sit on your hands for a week, couple of days, couple of months, even sometimes. The market's sitting there doing nothing. You're a momentum breakout specialist. You can't do anything. Now, could you go to other markets? Of course you could, but generally speaking, the broad perspective, if the equities are quiet, gold's often quiet, crude's often quiet, dollar's often quiet, they may be moving around, but you're not getting that kind of expansion and range sort of testing and backfilling that you might get on a momentum driven market. So there's option one. Now, option two, which I think is if you are really sort of learning your craft and improving and building this arsenal up. What option two is basically saying, hey, I'm a playbook trader, right? I have a selection of strategies that work in different market regimes. And so you adapt to the market regime, you take more trades, potentially smoothing out the equity curve over time. You don't have such a choppy equity curve. And you get more reps as well. So you get more experience in the market, you get to improve, you get to journal, you get to do all this kind of stuff. And so, this is a choice that you can make. It's a very personal choice. Depends on how much time you got to trade, your personality, all this type of stuff. But if we are going to build this into something that's sustainable and has long-term efficacy and long-term edge, you're going to have to pivot at some point. You can't use one strategy that's going to work forever, because you'll have to tweak and adjust it. Now, could you argue that you could use a momentum breakout strategy and it'll work forever? Maybe, but you're going to have to tweak and adjust as you go. So I think, and this is again my opinion on stuff, a better approach is to build a playbook of different setups and strategies. And the first port of call before you kind of deploy those is to work out the regime we are in. Okay, before we move on, I want to remind you guys, of course, that if you're trading a leveraged instrument, super risky. We know that, I think you know this by now, but margin is double-edged sword. When things are working great, fantastic, you're kind of leveraged up, you go long, what we do. When you're not and it goes against you, things can get nasty very quickly. So please just be aware of the risk you're taking if you're trading spread bet, CFD, any leveraged product, or getting involved in the market at all, right? That's really key. So and by the way, as I mentioned before, a lot of these webinars, I don't want to go over old ground. I don't want to. Sometimes we do attack different topics from, the same topic from different angles. If it's something that's, a struggle, like we're talking about discipline or holding trades, there's different ways and things that we can kind of approach that, and just to try and take things up and kick things up a gear. But very often, I want these webinars to be something that's kind of expanding your knowledge and helping you kick things up a notch, take things up take things up a notch, kick things up a gear. That's what we want. Kind of move things forward. And so very often, we've covered some stuff in depth before. You can find those in the Pepperstone YouTube channel if you go to the playlist section. They're there. They're also on my website, tradersmastermind.com as well. So if you're kind of thinking about, hey, I want to kind of deep dive into VWAP strategies, or I want to deep dive into some day trading strategies, evening trading strategies, whatever it might be, I've probably covered a lot of those before. I'm going to do some more. I think 2 weeks time, we're going to talk about two kind of fresh open strategies around the open. So obviously things change and adapt and adjust. So we'll always keep you updated if I think there's something to share. But just to let you know that we kind of build and build as we go forward. Okay, so let's talk about this, what I call the strategy quadrant. So if we are if we can assume that we're an option 2 trader, right? We're going to build this playbook. And I think that most, I don't want to say all, but that probably not. There's always someone doing something different. Most experienced traders have built themselves a selection of strategies that they deploy. Now, they might prefer one or the other. They might be better at one or the other. They might want to push more chips into the table and take on more risk for one trade setup rather than over the other. But I think that most traders with a decent level of experience, if you talk about a couple of decades, like I've got a couple of decades plus in the market, that sort of experience levels traders, maybe 5 years plus, let's say, don't need to be 2 decades, like some dinosaur like me in the market, but 5 years plus, they start to think, what, I need to have different ways of kind of capitalizing on the conditions we're in. So 4 quadrants is a kind of good framework to have, I think. One is your mean reversion scalp. One is a mean reversion hold, hold, momentum scalp, momentum hold. Now, when I say scalp, I don't necessarily mean, a couple of minutes trade or a couple of seconds trade or whatever that might be. It could be, depending on time frame you're on. It's basically an A to B trade. Some people call it level to level, but in other words, you're in, you're out, you're done. You're not looking for an extension of the move. You're not looking for a runner. You're not looking to be smart about it. You just think it's going to go from here to here. Now, that could be a finite level, like I think it's going to go from 99 to 110, or it could be I'm going to hold it until I see momentum dry up, or it could be I'm going to see if it pops back up the high, I'm going to take it out. But the point is, why I call it a scalp is different. So it's, if you're a higher time frame, a scalp might be for you maybe an hour, okay, and you're not used to holding it for days. But for most traders, if you're a day trader, scalp's going to be, that A to B type trade. A hold trade is pretty self-explanatory, right? It's a trade that you hold, believe it or not, a trade that you kind of think is going to run on. So as we were talking about with Elder here, we don't want it. What we're trying to achieve here today, and what we're trying to achieve in our trading generally, is being crystal clear about our objective with the trade. So we're not second guessing. We're not doing, what he's saying beginners are doing, which is, oh, I'm going to close a trade. No, I'm going to run it. And we're not doing that. We're kind of building our playbooks. We're putting them in each quadrant. And then we're saying, what are the market conditions? And let me deploy what I think is the right tool for the job and do the best I can with that trade setup I've got. So mean reversion scalp, mean reversion hold momentum scalp. We'll dig into more in a moment, but that's kind of, let's just kind of get the bigger picture here. So if you choose option two, going back to those two options, you either deploying one strategy and that's it, and you're a one-trick pony, and you have to, listen. Traders sometimes believe that the right way to move forward is to pick one strategy and to deploy that. I think that's correct. If you are a new trader, you want to do one thing and you want to just learn to do it, because you're learning about all sorts of stuff. You're learning about how economic data affects the market. You're learning about the ADR range of the day. You're learning about how the Asian range affects things. You're learning about inside days, outside, all the stuff that we know and love. So that knowledge needs to kind of be built. And so I'm a big advocate, if you're a new trader, just picking one strategy, thinking about expanding your playbook later on, but one strategy, one style. Now, this is where I think many traders slip up, is that they push that strategy every single day. And just like I alluded to before, if you're trading a breakout strategy in today's environment, so far, could shift, so far it's not going to work for you. And so the challenge, I think, with traders is to become good at one strategy and being patient enough to step back when the conditions are not right. Now, when you get more advanced and more developed as a trader, I think that's when we are talking about now, is that's when you say, okay, I'm going to trade slightly differently. It might not be your preferred way to trade, but you still believe there's edge, you still believe you have positive expectancy, and you still believe it's worth deploying capital. Now, you still may say, it's not for me, I don't want to trade this, it's not my type of environment. I'm not saying trade everything, but I'm saying that sometimes we have conditions, and I've traded through a lot of different market environments, like I say, a couple of decades plus. I've seen times when we've had your grinding up moves, we've had volatility, we've had your bear markets, bull markets, sideways markets, range bound rotation, very, very different environments. And sometimes these come and they stay for months. And if you're a one-trick pony, then what do? You kind of have to reinvent yourself. So if you choose option two, your job is to build a mixed playbook of strategies, setups, covering those four quadrants that's the framework I like to think of it. And then you're picking the right tool for the job. Example here, in April, we had, of course, the tariff stuff, and the market was swinging all over the place. It was a very, very volatile environment, and you had to deploy a strategy that was aligned with those conditions or sit out, right? I'm not sure if I should put this slide here. Oh, yeah, last week, and I think why I put this slide here, maybe you should have gone before. So last week we talked about mapping your market with AI. This aligns with the strategy quadrant. So, we are identifying the market regime we are in. And if you haven't watched this recording, I think the recording's there now, or it should be sent to you. What we're doing there is using AI to kind of really help us, as soon as we possibly can, define the market conditions we're in. And when I say AI, I'm saying load it into like ChatGPT. We're not some fancy tool or something, right? So the idea was we're trying to get as soon as possible, as quick as possible, a guide as to the regime we're in, so we know which quadrant we want to use for the playbook for the day, or step aside. I suppose that's the fifth quadrant, right? Is do nothing, and that should be the default for any trader anyway. But if we're mapping the market and we're saying, hey, I think we are due a range expansion type day here, then we're not going to take mean reversion scalps, right? We are going to probably look to align, or we could do, I've got some examples for you. We're probably going to look to align, in one direction, and we're going to look for kind of trades to hold. That's the time when we're, as Elder said, we're not going to be thinking about taking stuff off the table quickly. We believe all the evidence is suggesting a breakout trend type day, low to high type day. We talked about that last week. There, go over old ground. Okay, that's the quadrant I think we're in. While I'm still getting data that's reinforcing that, those are the trades I'm going to take. I'm going to try and hold them and trying to squeeze as much as I can out of them. I'm not going to kind of be sharp with my exits and grab that unrealized P&L. Very, very different to, let's say, the data suggested, inside day, we're opening inside the range, we're waiting for FOMC here, we're doing this, we're doing that. I'm probably going to overstay my welcome if I try and hold trades. And so you look to the other quadrant. So this is why kind of things line up and hopefully just build on, what we're covering each week. So I believe that, well, I don't believe, I know that the market regime is dynamic. And what I mean by this is that the regime can shift quite quickly. We can be chopping around, rotating up and down, doing not a lot. Or it depends, it's going to be the perfect environment for you. The rotations are good enough to get on, they're not so wild, the stops are sensible. Again, this is where it becomes a very personal experience for trading. But it can shift very quickly. It can just go into, some sort of news comes out, and all of a sudden it's kind of risk off environment. We saw that quite a lot in April. Everything was going well, and then all of a sudden some sort of tweak would come out, and the rug would just be pulled, and the market would just fall through the floor. Or the natural ebb and flow of the market and the rhythm, etc. So, at the moment, being headline driven, this is very, very important to understand that the market regime is dynamic. And why I put this slide up here, and it can change intraday, intra-quarter, whatever time frame you want. And why I put this slide up here is that I think there's this a misconception that a good trader can read the market all the time and understand exactly where it's going, what it's doing, how it's going to behave, which is just simply not true. It's simply not true. A good trader knows when they have edge and knows when they don't have edge. That's the separator. That's the difference. And as for your developing trader working out your edge, that's fine. But your main objective is to say, I'm never going to be perfect. And it's the imperfection that makes trading possible. Kind of mentioned this before. That's why we get these movements, is because there is no perfection there. People have different opinions, different viewpoints on whether it's going up or down or whatever, and that's how we capitalize on opportunity, right? There's urgency, a supply demand shift, and so why I mention this is we're not trying to solve for perfection. We're not trying to say my number one goal is I want to absolutely 100% of the time make sure I understand what the market is doing. No, because it sometimes shifts. Even you have every evidence pointing towards it being a rotational mean reverting day, and it shifts into a massive trend day. We just have to adjust and adapt, or we stay out depending on how you want to play it. We don't know what's going to happen. Of course, we don't know, and it's okay not to know. But what's not okay is to be stubborn and to not have a process for recalibrating to market conditions. So let's talk about kind of step one here. The first thing is we want to categorize the market regime. So how do we do this? First port of call really is to look at the higher time frame. Do we have kind of volatility like we had back in April that's kind of quite unpredictable? From a swing trader's perspective, if you were swing trading back in April, it was just luck if you kind of got on something because it would rip off, come back. It would be very, very volatile. Day traders a little bit more different, a bit more interesting. Example here, little screenshot, persistent selling, Euro USD. So I'll go a few more examples in a moment, but categorizing the market regime, and you make your own labels up for it. And one might be, okay, we've got persistent selling, and another might be we've got rotating higher, we've got grinding higher. Each market, or not necessarily each market, but each regime has a different rhythm. And this is up to you to dig in and try and categorize the market conditions we're in at the moment and say, okay, the higher time frame, we're grinding higher, or the higher time frame, we're range bound, or the higher time frame, we're rotating higher. Notice, we've got to be smart here, guys. There's a nuance. Uptrend or downtrend is not enough. That's beginner stuff, right? It's in an uptrend, it's in a downtrend. Well, all right, genius. We need to be a little bit more smarter than that. Why? Two examples: S&P 500 moving higher, DAX moving higher. Very, very different conditions. Okay, the different time periods. That's a point, right? Rotating higher, up, down, up, down, up, down, up, down. It's two-way trade in an uptrend versus grinding higher. It's up, 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 one red, up, up. You see the difference, right? Yes, they're an uptrend, but that's not enough. We have to align with conditions. And so, not to get ahead of ourselves, if you would identify the regime as a rotational uptrend, then maybe you can deploy mean reversion shorts when the time's right. Because when it's stretched, there's opportunity maybe to take a couple of red days there. And, okay, fine. There's a lot of people say trade with the trend, trade with the trend. And maybe you don't want to do that. But as traders, there might be an opportunity then for a kind of a midweek sell-off. There might be an opportunity to take a peak from highs down to lows. But you wouldn't want to do that if you were grinding higher in the DAX. You would say to yourself, hey, regardless whether you're a day trader, scalper, whatever, you're like, hang on a second, No, we're grinding higher here. I'm not trading mean reversion shorts because I don't have the same rhythm that I'm looking for. The regime is wrong. And the argument, counter argument is, well, you're a good trader, you can make money in all conditions. Maybe, but it's aligning the right tool for the job at hand. And honestly, this is one of the biggest kind of breakthroughs for many traders to say, yes, you know what, this is the regime we're in, like it or not. Right? Like it or not, we're sitting at all-time highs on the Nasdaq. Like it or not, believe it, hate it, love it, whatever your opinion is on it, the market is a bull market. We're sitting at highs. Now, does it make sense then to kind of try and pick tops? I don't think it does. Like it doesn't. So that's, we've got to kind of identify the rhythm we're in, the regime, and just be a trader, not an analyst, not a predictor, not an economist. Like it's a trader. Look at the market you're in, how are we trending, what's the price action? Again, be smart, take it another level. What are we doing? Just get a feel for it, and then the next question: how do I align with that? So which setup quadrant matches which market is basically what we're trying to do. Okay, so some examples in a second, but thinking about the mean reversion hold quadrant. So this is going to be like in a directional market. Okay, you've got a market that's moving. And by the way, you might say, hang on a second, Mark, mean reversion, that's a range bound market's job. That's a range bound market. Yes, but it's not a hold. If you're in a range bound market, let's say today, until we've just broken out 2 seconds ago, today you're kind of looking for low to high, high to VWAP, low to VWAP type of stuff, right? You're not looking to hold. It's a directional market on the higher time frames, rotating today. Today, if you're aligning with the current regime, you're like, no, I'm not holding anything. It's not proven that it's going to break out. And so if you're holding stuff, you're going to sit there and it comes all the way back and stops you out again. And so you want that directional market, preferably a rotational trend, like we saw on that little S&P example, little rotational trend. Now you can trade mean reversion, but you hold. And so you kind of buying those pullbacks, mean reverting back to a level, you're buying kind of lows, mean reverting back, and then you're holding, looking for kind of further moves. So VWAP tags you're buying, low tests, signs of support. You're saying, hey, we're in a rotational uptrending market. The tide is rising. Okay, I'm not necessarily going to go crazy for momentum breakouts because it's rotational still, but in an uptrend. But if we're mean reverting and I can catch a kind of low swing and I can hold it back to a VWAP or back to a high and then maybe look for further extension, you see why this is different or why this is now aligning with conditions. We're not trying to be smart here. We're not trying to outthink the market. We're just saying, well, look at the conditions. How do I make the most out of those? Well, let's start by using the right tool for the job. And then we're kind of holding as the market goes higher. Here's a good example here. You had a classic Wyckoff spring. That was you bought that as a mean reversion type trade there. You might then hold it for a hold higher. And if you're a swing trader, you're holding for day 2, day 3, and probably out on day 3, even though day 4 gapped up. But maybe you're holding intraday, you're buying that spring to the low side, breaks to the low, classic Wyckoff spring setup, pops back up. You're not looking for a scalp. You're looking to hold it a little bit longer because the market conditions are still in an uptrend. Are you always going to get it right? No, but this stops you from doing what Elder says and going, should I hold it? Should I not? Should I hold it? Should I not? You already know what you're going to do. Mean reversion scalp. So look at the other quadrant now. That's an outside in type trade. So in other words, market's gone up. It's coming back to a level it was at. I was printing at where price was before. I still think that actually if the market's gone higher, rotated lower, mean reversion is still could be a push back up towards the highs where price was, because that might still be a mean that might have been sitting there for a while. It's basically going back where price was. Momentum to me is kind of you're going with the flow, going with the aggression, going with kind of where the flow and the trades are pushing the market. So mean reversion scalp, exhaustion moves, flushes, support or resistance plays, stuff that stuff that you probably play yourself, right? And these are quick counter trend moves based on these short-term price efficiencies. If you're a day trader, if you're a swing trader, obviously it's not short-term. But the idea here is you're not overstaying your welcome. You say, hey, I think there's edge, and this is why they tend to be on the lower time frames. I think there's edge here. I think the spring is stretched. Supply demand is massively shifted. I always imagine supply demand. You've got this seesaw, if you like. Supply demand shifts, and when it shifts really one way, it can only go back the other way. You observe that. But yet, say you're in a heavy downtrend, right? And you see an exhaustion, you're not going to overstay your welcome and think I'm going to hold this and do an elder and say, well, I'm going to hold this for a pushback to highs. No, no, no. You're going to say, hang on a second, there's still edge here in trading a mean reversion scalp trade, but there's not edge trading exactly the same setup and trying to hold it. You see the distinct difference. They don't have to be completely new setups and strategies. They can be, but you can trade exactly the same thing, but just how you manage it changes it, I believe, from a negative expectancy to a positive expectancy. And that all comes from how you calibrate the regime you're in. Rotational market, great. You're there, you're trading, downtrending market. You can take that mean reversion extension, that's flushing down, bang on a pop back up. But I'm not looking for a complete reversal. That's going to come more than likely going to roll back over and stop you out. So two exact same trades, exact same entries, but the management is different, makes all the difference from being a trade that has positive expectancy and a trade that has negative expectancy. And this is the challenge we see, this is the challenge we all have with traders, is trying to align and trying to know whether the whole trades or not. Are we always going to get it right? No, we're not. But if we're clear about the objective of the trade we're taking and the segment we're in, life gets a lot easier. If you're in the trade and you go, this is a scalp trade and my exit criteria is this X, then if it rips off and it does a full scale V-shaped reversal, you go, okay, well, so what? If it's okay, I'm going to hold this and it comes back and stops you out, you go, well, so what? I planned for that. Maybe I need to be better at calibrating to conditions, but I'm not fighting in my brain. And I'm not kind of going, I'm what trade this one setup, I don't trade this thing. It's like, no, make those adjustments, become a multi-playbook trader. So you have maybe the same setup, but there's a scalp version, there's a trade to hold version. Or maybe there's different little nuances, little differences, right? It doesn't have to be the same thing, it doesn't have to be different things. Example here, NASDAQ pushing down, you quite reasonably have taken a long mean reversion trade there on that little wick, right? It'll tail to the downside, sorry. You're a day trader, you spot that shift, fine, you take that trade. But are you trying to look for it to hold for a full scale reversal back? Probably not, unless your objective is that, of course. But the difference is there. And then listen, let's go to momentum scalp. So mean reversion scalp is market comes to you. Let's say you grab that wick, it pops back up, you scalp it out, you take your money, you run, you say, I've got $40, move out the NASDAQ times my position size. Thank you very much. That was my job for the day. I am done. Versus the other trader, and maybe you do all these as well, is you say, hang on, I see that momentum's a downside. We've broken through prior day's lows. It's a one-way street. I'm jumping on a little pause, a little flag, a little pullback, right? You jump in, you ride the wave, you jump off. So you can use different strategies intraday as the regime shifts. But this is what the power of being like a multi-playbook trader is, that you're clear with the objective. That's the distinction. You're clear with what you're trying to do. You're like, hey, I am going to scalp this momentum. I'm going to jump on. I'm going to jump off. My signal for jumping on is maybe a break at low. My signal for jumping off is I'm going to trail, or I'm going to come out as first sign of a pause, or whatever it might be, right? It doesn't matter what that is. You're looking for momentum to jump on. You hit it, you see it, you hit it, you get out, and you're not overstaying your welcome. It's in a different quadrant. And so you go there with purpose and intention versus momentum hold. And why I've used the same screenshot here is to kind of show how the regime can shift and how you can deploy different strategies depending on what quadrant you think is the most effective for the time of day you're in and for the market regime, which can shift by hour to hour. Not always, today not really, but sometimes it does. And your momentum hold might be, hang on a second, I don't want to, let's say you sort of saw it rolling over and you jumped on the momentum to the downside. That's not a scalp trade now, because other things have lined up and have said to you, listen, we tried to push higher, we failed. We're now coming into the final hour of the day and we're rolling over. Everyone is pulling the rug. I don't want to scalp this out. That's not it. Okay, fine. But maybe you would still make profit from that trade, but that's not long-term edge. Long-term edge is to identify this and say this is a hold, and be kind of, confident with that and say, I've identified now, this is a momentum trade that I want to hold. I'm going to drag my stop as I need to, but I'm not going to touch this. I'm not going to be seduced by the unrealized P&L. It is in this segment. I've categorized the market as a momentum market, which is, I believe, is going to run on, right or wrong, but it's your flag in the ground, and then you ride the wave and you don't exit early. You don't flip-flop between saying, I'm going to scalp it, I'm going to hold it. Now, if you say I'm just going to scalp, then fine, you stick to that. But this is why these kind of the multi-playbook is so effective, is because, or can be so effective, depending on how it's deployed, right? Is because you use the tool for the job. But it's, I think, in the magic, if you like, I hate using words like that, but it comes from the certainty, because you go in there knowing you're going to scalp momentum. You go in there knowing you're going to hold this mean reversion trade. And so everything you look at is supporting or not or what's the opposite of supporting? I don't know, hurting the decision, right? So you look at all the evidence, whatever you may look at. You're watching price. Is it okay? I'm still in the right regime. Yep, fine. Okay, there's my entry. Bang. How am I managing this? I'm dragging it up. I'm waiting to come out. Done. There's momentum scalp done. Versus, hang on a second, I'm waiting for this, right? I know I'm going to hold this. We still yet, end of the day's here. We've got this, we've got that. That level's broken. It's holding below the low. Good. All lining up still with the quadrant I believe we're in. Take the trade. Now you have no urge then to scalp it out because you've been so focused on holding the trade. It just helps you frame things mentally so much better when you can operate like this. Okay, so I mentioned that, very often, this as well as I do, guys. Intraday regimes shift a lot. We have conditions that are one, then they turn into another. And so, a good kind of way to approach this is to say, hey, do I need to reanalyze what's happening intraday and adjust which quadrant I'm deploying? Maybe you're sitting there scalping away and you look at the market and you go, do you know what? I'm missing out on stuff here because it's just a one-way street. Do I need to kind of look for something different? Do I need to adjust and adapt and become that multi-playbook trader that I'm trying to become? Maybe your comfort zone is scalping. Maybe your comfort zone is grabbing a little bit and moving off, but actually you're leaving money on the table, and arguably that has negative expectancy over time because you'll push it and push it and push it and push it when the environment's not right for it. And so, as you kind of build this playbook out, and you have these different ideas and themes, then you become an expert, if you like, at when to deploy them. So some example strategy buckets, right? And again, I don't dig in massively, limited time on here. I don't want to go and skim over stuff that's irrelevant. If I'm going to do it, I'll do it properly. So momentum scalp example. And I know you guys have been trading for a while, so you understand what I mean here. Just to give you an idea of where the bucket might be, the different conditions of the different setups. So you've had a bull flag or a bear flag, right? Momentum scalp might be, you see it flagging, it dips below the low, you buy it, you scale out as soon as it comes into fresh eyes. If you're in momentum scalp mode, if that's the way you've categorized the market. If you're in momentum hold mode, let's say you think we're going to close at highs. Let's say you think we're in the right conditions. You looked at the daily, you've done your analysis, you've done all the stuff, you've backed up with kind of data and support, and you go, right, I will still take the same flag, but I'm not going to scalp it out because I'm crystal clear that I'm holding this trade. And you might hold it for a full ATR move, a new level, whatever it might be. Mean reversion scalp, exhaustion flush, like we talked about. Maybe you just want to see the flush, see it pop back up, you're out. The hold might be, hey, I think we're going to hold right, we're going to push right back up. I think that we're still in an uptrend. We still have I have the wind behind me. We are, on a lower time frame, we are flushing to the lows, but this is not a scalp. This is something I think might be the start of a bigger move, and that's where you get the more decent R multiples. Breakouts, you're looking for kind of a volatility expansion, pullback, trail, a momentum hold type thing. Mean reversion scalp bouncing off VWAP. You might just, a lot of you guys trade VWAP, right? Market comes down to it. You might see it stall, you grab it pops up, you're done. It's a mean reversion scalp type trade. You're not looking to hold it because maybe the environment is very different. Maybe it's one up day after multiple down days, so you're not trying to overstay your welcome. Versus mean reversion hold might be, hey, we're in a bull market, everything's looking good, it's come back, it's pulled to the VWAP, I'm going to buy this. think we're going to push back up to where we were doing some business earlier before. And there's other examples there. Take pauses are the Wyckoff spring. Sometimes you might just want to cash flow that trade as it pops up. Sometimes you might want to say that's the low of the day. I'm going to push it to highs. Opening range breakout type stuff, VWAP magnet, open failure, afternoon breakout. You can see what we mean. And hopefully you understand that, yes, there are potential different strategies. So the strategies that you have, you sit down and you identify them, you print them out, your Google Doc, whatever you've got, piece of paper, and you say, hey, where does this really shine? Like, maybe you haven't done that exercise yet, but that's worth doing. You say to yourself, hey, I have this strategy. Where does it really shine? Where does this really work well? Okay, well, it works well when the daily's an uptrend. It works well when I'm here. Okay, fine. So I'm going to put that in the momentum hold bucket because I kind of jumped on that momentum at the open. I had that bull flag ad and I try and hold that to the end of the day. Okay, fine. What's my mean reversion scalp? What's my mean reversion hold? And maybe you say, Mark, hey, listen, I don't like trading mean reversion scalps. I don't want to be that. Fine, then you get rid of them. But what you do then for that segment is you say, what are the warning signs that mean I should not be trading? Well, actually, days like today, very low opening rate, a very kind of a narrow opening range, opening within the prior day's range, oscillatory off the VWAP. Okay, we're in a mean reversion scalp mode. That's not my thing. I decided not to play that game, so you take a break. But having this categorization and the subtle difference of how you execute and manage the trade really helps you with confidence and clarity. And that's kind of the biggest thing. You're never going to get it right. Like I said before, there's no perfection here. We're not trying to master it, so to speak. We're just trying to get better at knowing when to push chips in the table. And from that perspective as well, there are some of these which you will be better at than others, right? You will know, you're thinking to yourself, actually, I'm very good at trading reversals, and I want to come in and get out, and I trade the reversal, and it's a scalp type trade. In that case, you might say that my R unit is 4R, and my R unit on momentum hold trades, which maybe you don't like chasing, you can't read momentum as much, you're always a bit fearful of it. You might say, well, that's 1R or half an R, because I still believe I've got edge. I still believe there's positive expectancy here on these flags, these breakouts, these news reprices, take pauses, whatever it might be. But I struggle to kind of make much of these. I'm not that great at them. I could be doing better. Well, just reduce your risk. So you can, now that you get more reps in the market, you can trade different conditions, but you adjust how much risk you're prepared to take for each of the conditions you're in. You're like, yeah, man, this is momentum scalp market. I love that. I'm really good at that. Okay, well, in which case maybe you up your risk for the day, your daily risk allocation, your weekly risk allocation, however you bucket things up. And so, becoming a good trader is about, elevating your thinking and kind of taking things up a notch from the classical, well, it's a bull flag. Well, we know what a bull flag is, right? We know what a bull flag is. Well, where does it work best? What regime are we in? How do I deploy the capital? What am I looking for specifically? How am I going to manage this? And doing all that extra work that no one else, but a lot of traders don't do, and they get those really mediocre results. But actually, you're going, well, you know what? This is actually a hard trade to hold. I'm bucketing it in this. The regime's this. Da, 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 da. And so you start to get good at really knowing what you're good at, where you're going to push the chips in, what you're not very good at, what maybe you want to improve on, or what you want to get out, really steer clear of completely. And also the main thing is really getting good at categorizing the regime. So we talked about a lot of that last week, of being the expert and knowing the market like the back of your hand, of being good at being able to adapt intraday when the regime shifts. And that might be pulling yourself away and going, hang on, I'm not very good at shifting from a mean reversion scalp type environment to a momentum hold environment, and that normally comes from a reprice, right? Some sort of news. I'm not very good at that. Okay, fine. You have your own process for recalibration adjustment, but it works so much better when you, rather than going in with a complete fresh slate and saying, I don't know what I want to do today, let's just see what happens, which is deadly. Again, I'm not saying that you predict, but I think that having some kind of idea and roadmap of what you expect doesn't necessarily have to be detailed with, I think the price is going to go here and pull back and do this and 50-point pullback, 100-point rally. No one's expecting that, right? But you could say all the things suggest today is going to be an inside day. So what does that mean for you? It means, we're in an uptrend, inside day, uptrend. Okay, there's no momentum holds. There's no way that immediately eliminates that segment, right? I'm not buying highs and looking to hold it because I still believe we're an inside day, and that would be the worst possible thing. So let's get rid of that segment. And you start thinking, you go, okay, well, maybe I could do momentum scalp. Yeah, maybe you do. Maybe you say, you know what? If it's within range still, I don't mind jumping on, jumping off for a bit of profit. That's fine. And maybe you say, actually, a mean reversion hold will work well because I think we're going to be a doji type day, and actually, I think we're going to kind of push from low, whatever it might be. You get the idea. You're kind of framing the day in your mind and becoming a little bit more professional with your approach. Well, not professional. You're becoming a little bit more intentional with your approach. Okay, intraday regime shifts. Talked about these. For you intraday traders, you know this already, right? You segment the day off. So you go open or Asian session, London session, US session, whatever you trade. If you trade currency pairs, if you trade US equities or European equities, you've got momentum at the open, your midday chop, or it could be choppy depending on what it is. You probably want to trade mean reversion in there, and maybe power hour again in the afternoon if we're in the right environment for that. So let's move on quickly to building your playbook. So how do you kind of build this type of stuff? Well, one of the easiest ways that I do, and this is a little screenshot of my desktop on one of the screens. As soon as you see something, clip it, drag it into the folder. Have the folders there. This makes kind of building these playbooks easy. Then later on, you have the categories for where these fit. So momentum ignition, I've got Wyckoff spring, pulse breakout, I've got a tick squeeze, open reversal, blah, 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 right? And nemesis there is kind of the stuff to avoid completely. So the fifth quadrant of stay the hell out because this stuff doesn't work for me. And so, you know, as you kind of evolve as a trader, a lot of people talk about building your playbooks, you're documenting and stuff. If you find yourself fatigued at the end of the day, find yourself lacking time to do it in depth, this is a really good starting point. You know, you kind of build this living library, if you like, where you just snip stuff, drag it in, snip stuff, drag it in. And then when you get that chunk of free time, you can go through it, categorize it a bit, and go, oh, I remember that there. Okay, that sits in that quadrant. How do I manage that? What's my risk allocation there? And so what you're doing is, you know, because a lot of traders have this, and I get it, especially if you're a trader who can't allocate so much time to the screens. You know the things you want to be doing. I want to be building that playbook library. I want to be doing this, but I've got to do this. I've got to do that. I've got to do the other. I've got to do it to work. I've got to do it. I get it. I understand. So this is a way that you can kind of keep track of the things when you see them real time when you're there, or if you're reviewing stuff, you drag it quickly into a folder, and then when you get time to bulk kind of review, then you can start to tag, then you can start to build up your docs, you can build up all your kind of resources and library of stuff. But this is a really kind of smooth way, I think, that you can kind of capitalize on your screen time, bucket the certain environment that you like, the setup that you see, and then later on you put it into the quadrant so that you can kind of move from there. Okay, so just a quick summary. The multi-playbook method. The market doesn't always suit your favorite setup, so consider building more than one. With the caveat that if you're brand new to trading, I'm a big advocate of just sticking to one thing for now. When you start to get more experience, that's when you want to explore different avenues, the holding the trades, this, that, the other stuff we talked about. Consider categorizing your strategies by type, mean reversion, momentum, and style, scalp or hold. And as I say, scalp means different things to different people, but it's A to B trades versus a trade you're looking to hold for a bigger move. And by the way, this comes in waves. Like at the moment, the last couple of days or so, you might be like, I don't want to hold anything. You know, we might be in a bull market, but we've kind of been consolidating after the 4th of July, blah, blah. Yeah, maybe you don't want to hold anything. That's okay. And that's what happens, actually. The market will stay in this rhythm and regime for a period of time and then jump out of it. Maybe it'll come back. So you have to be, and it's never going to go, hey, by the way, this is the market I'm in today. It gives you clues, and that's our job as a trader, to try to identify, what we think is the conditions, but we can never be 100% sure, right? Know your conditions and select the right quadrant. Which variables are quadrant clues? We talked a little bit about this last week. Opening range type of stuff, where we open in the prior day's range. How prices behave, any times does it rotate around VWAP? How does it approach prior day's high, prior day's low, inside day? All that kind of stuff. What's suitable for you in the market that you trade? Start to keep that library of setups with screenshots for now. Drag them into a folder, drag them in, drag them in, drag them in. It takes seconds. And then you start to build some notes. So you start to build that playbook that you may not have had time to do. You start to say, hang on a second, that there now is my mean reversion scalp playbook, and I've got 50 screenshots from different trades, different markets, different environments. Okay, great. Let me look through it. So when you have time, you can go through and you can actually look. And I think the edge isn't having more trades, um, which might be obvious, right? It's deploying the right strategy at the right time. Very often I see this with traders that have got really good setup, really good play, really good strategy, but it's just in the wrong conditions. Force it. You've probably done this. We've all done it, right? You're trying to force a trade that's actually good, but the conditions are just not right. Or you try to hold a trade that and you're like, I want to hold this, and you're asking for too much from the market. You're asking for the market to shift regimes completely, right? So building this multi-playbook method is about as I say, kicking things up a level as a trader and saying, right, I have this setup or a couple of setups. What's the management adjustment I need to make for the conditions we're in? Sometimes, like I say, it's the same setup, but it's a slightly different management. And you go, and then having that certainty when you're going, so you're not flip flopping, and your mind is saying, well, take it, it's a scalp, I'm going to hold it. No, I'm going to hold this because of X, Y, Z. I think that's the quadrant we're in. It's not for me to take trades out here. The edge here is to hold it. Now, if over time you realize that your read is not so good and accurate, then you adjust that. You don't adjust the setup and say that doesn't work. I've tried that. It's losing me money. Don't do that. You say, well, actually, maybe my regime identification is wrong. I need to become better at that. So then you kind of run through different regimes and getting better. Okay, so let's take some questions, guys. If you have any questions, happy to take questions. I want to remind you, we've hit 30 something thousand downloads of my free discipline tracker. I know you've all got it already, but if you haven't, go and get it. Tradersmastermind.com, top right, I think it is. Totally free. But I looked at the downloads number, I was like, 35,000. I wonder how many people are actually using it, how many people are not. I do get some emails now and then from people who say, you know what, that changed my trading for the good. It's a way to track your discipline and stuff. So if you're struggling with holding or sticking to your plan, if you're struggling with kind of sticking to let's say you're kind of trying to review the regime and you kind of sometimes jump into the market too early, that type of stuff, then this is it's there. It's completely free. There's nothing else other than put your email address in. You'll go into my daily email, which you can unsubscribe from if you don't like it. But again, it's just I think it's value. But yeah, 30 something thousand downloads of that bad boy. Maybe you'll be the 30,001st. All right. I'll take a few questions, guys, if you would like to. And also, yeah, I don't thank them enough. But thank you, Pepperstone, for kind of partnering together with us and allowing me to talk about pretty much anything that I like. I don't think they've ever said to me, no, they've never said to me, no, you can't talk about that. They trust me to share with you the things that are going to help traders the most. And actually, when that number they have to put on, and we have to put on the percentage, that's gone down a bit. I'm like, okay, good. And as in the number of traders that lose money, we know that it's a dangerous game. We know the majority of traders do, but that number's going down. It'd be nice to think let's just squeeze that number lower and lower and lower, so that more traders are taking some profits from the market. But it's a tricky business. Okay. Thank you, Theo's off the right at the beginning there, Theo. Good for you, mate, for telling me about the audio is working. And I didn't see that, but good to see you, pal. Let me move you guys over here because I always feel like I'm talking to the other screen. By the way, next week, if you've got to go, I understand. Next week, we are talking about solving the confirmation. No, we're not. That's the week after. Oh, is it 5 weeks in July? Yeah. 2 setups for navigating the open. Yes, I talked about the 2 setups I like at the moment that I'm going to share with you in detail. Just those 2 opening setups with the structure, filters, stop logic, all the kind of traps and stuff that go with that. So we're going to go kind of back to operations for that. Then we're going to talk about confirmation, how I kind of frame that in my mind and the framework I think that might help you there. And the last webinar of the month will be this terrain target trigger framework, which I think is another great way of thinking about how to execute trades. Okay, so Theo says, Mark, I'm finding that once I have developed my justification for the price I want to exit, then even if it runs on and on, I find it much easier to swallow any missed profits. Once I've developed my justification for the exit, okay, Theo, good. Do you know Someone says, or I think a trader mentioned this a while ago, you can never get it perfectly right in trading. And if you beat yourself up for market going on without you, a market doing this, doing that, then every single trade will be, an emotional roller coaster. And I think being at peace with your decision, and it kind of, aligns with, what we're saying here, which is why you mentioned it, I think, is that, if you decide I'm scalping this, it's an A to B trade. That's the decision I've made. I may be wrong, but I've made that with the information I've got. I've done my very best. I think that's the right decision. That's all I can do. Here's my risk. Here's my exit idea, whether it's a level, whether it's a time, running it for 15 minutes, half an hour, an hour, whether it's momentum, whatever it might be, whatever exit criteria is, and you stick with that, and then you see the market go your way, you take it, and it just rips off and it carries on another 1,000 points without you, and you're at peace with it, and congratulations, man, you've really taken it to another level. I've said that so many times tonight, forgive me. You've really kind of grown as a trader, because that's when you go, hey, have I read it wrong? No, I wanted to scalp it out, and I'm at peace with that. And I think that that's a very good place to get to, Theo, and others listening. If you get to the point where you make a conscious decision of what you're trying to do, and then you do it, and if that happens to be wrong, you're at peace with it. That's a very good way of thinking of stuff. Theo also said, I found that the continually adding to and reviewing my playbooks each day, part of my pre-market checklist, helps train my brain to see patterns, etc. Far easier to spot things in the live market, I find. Yeah, good, Theo. And also, if you're adding in your replays to your kind of your process, your post-market regime as well, you go through and you say, hang on a second, and maybe I need to make a little minor adjustment. Maybe I need to the scalp trade I can hold a little bit longer. It's still a scalp, but I can probably squeeze a bit more. Do I need to look at the ADR and see if does that need to be dynamic, that? And so these little tiny minor adjustments, where you where I believe the edge is. Trading is simple, but it's not easy. And I think you absolutely should keep things simple to a certain extent, but there's a time to really dig into it and to kind of become obsessed with the nuance, because that's where the edge is narrow, right? The edge is thin, guys, and the separator between a losing trade, a winning trade, a losing month, a losing year, it's narrower than we like. And so I want to put every single ounce of effort I can, and you do as well, into without overcomplicating it. And I get it, there's a balance there, but it's not simple as a market's going to kind of go up, I'm going to go long. Yeah, that should be the kind of benchmark, but it's like, okay, well, have I checked the regime? Have I checked this? Have I checked that? Have I checked the other? Okay, fine. Then it's a simplistic, well, I've made the decision with confidence, but there is kind of more to it, right? Gary says, just say thanks, always get value from the sessions. Thank you, Gary. And I know you're on regularly, so I really appreciate you guys. I appreciate all you guys coming on live. Honestly, I know some of you watching recording, fine, you can't make it for whatever reason, but it makes it engaging, especially with the questions. And I know people are actually there, not talking to nobody. But I appreciate the feedback, guys. I really do. Rob says, hi, Mark. Thanks again for the great session. Thank you, Rob. Really appreciate that. Alison, thanks so much. Thank you so much, Mark. Valuable content. Thank you, Alison. Okay. Rob says, you've mentioned before the session open, it's normally very choppy. So how long would you advise to wait before getting in? 30 minutes or 1 hour? It depends on, I think this is a good question, Rob, because it depends on your higher time frame, segmentation and analysis, right? If you think that the higher time frame is poised to break out to highs, let's say it's been rallying 1 day red, now it's opening up a little bit, you think, hang on a second, I really do think we're going to take out the prior high, and your idea is for kind of mean reversion hold, momentum hold, you're in the hold category, the segment, you're not sure, then I think, if it's chopping around, you're just waiting for some clarity and you're kind of bracketing, and that might be 30 minutes, that might be an hour. You let price dictate that. And often I'll say, listen, I want it, and it's got to break this before I even get involved with this, because I might want to get long, but I'm not going to guess. If it's momentum, I'll jump on the momentum and I'll ride that and I'll hold it. If it's mean reversion, I get a tag at lows, I'll take that too. But I kind of want to wait and see what the regime is. I still think we're in a hold regime, but I don't quite know where we are. And so I think short answer to, well, a long answer to a short question, Rob, is to let the price action dictate. And what I will say is if in doubt, man, take no trade. I'd much prefer to be on the side of missing stuff than over trading. Missing stuff doesn't lose you any money. It doesn't make you any money, but over trading costs you money. And so you want to be at a point where you kind of feel a little bit of regret, not so much your revenge trading, but like, maybe I should have got that. Maybe I should have got that. That's better than saying, damn it, I shouldn't have taken that. Damn, I shouldn't have taken that. So for your question of if it's very, very choppy, just bracket it, set alerts in and go, you know what? Let's see what happens. And also, I also believe that you need to watch how price reacts to breaking the range. If it's been super choppy, like I don't just take it on a break of the range unless it's a really high conviction, high time frame trade. Let it prove itself. Let it develop into a more of a trending environment or a kind of momentum type environment. I hope that's helped somewhat, Rob. Thank you for the question. Always good questions from you, pal. Faith says, can we get the recordings after the sessions? Faith, yes, they will be sent to you. If they're not, then you can send me an email, reply to my daily email. That always comes to me, and Armand actually deals with that. He'll send you a copy of the recordings. By the way, daily email, I didn't half mention this. Send an email every day. It's for traders. We talk about all sorts of stuff, this type of thing, mindset, quotes, a big fan of quotes, stoic quotes, war quotes, AI breakthroughs, prompts you can use for ChatGPT, all that type of stuff. You guys seem to like it. Massive amount of opens actually and clicks and stuff. So I really appreciate that. So if you want to log on, subscribe to that, you can. Okay, enough plugging my free stuff. Sandeep says, appreciate today's webinar. Thank you, Sandeep. Thank you so much, pal. Rob says, thank you for clearing that up. Gary says, great comment on missing a trade, better than over trading. Yeah, it is, Gary. Absolutely it is. Last couple of questions here. Eric says, if I execute my edge and it starts consolidating, do I take small profit and take another trade on breakout? Personally, no. For me, and actually, if you listen to any of these guys, where is he? Where's Jesse Livermore gone? Have I taken him out? I might have taken him out. Jesse Livermore, right? Great book, Reminiscences of a Stock Operator. If you haven't read it yet, he's got a great quote in there, Eric. It says, I don't know what the quote is because I butcher it, but it basically means giving up your position. You do not want to give up your position. Because you ask yourself this, how many times have you actually got back into a trade? How many times have you really got back into it when you've taken it off? I think it's harder to get back in when you're out. Now, so I think it's, again, personal. I'm not telling another man how to trade, but personally, I think that if it starts consolidating, think about why you're taking profit. You're taking profit because you fear giving back the unrealized. That's the only reason. If your actual thesis for the trade was you believed it was going to kind of break out and you were kind of getting an early before the breakout, which by the way, I'm a big fan of, right? Preempting the breakout. I love that type of thing. And when the environment's not quite as aggressive, you kind of want to preempt it. So you've got a choice where you do break out. You've got to ask yourself the question, Eric, well, why am I taking profits? If you're taking profits because that was the plan, then good, you do that. And if the breakout's a separate trade, then fine. But if you were there for the breakout and now it's consolidating, this fear that's probably dictating your decision-making process there is the fear of giving back the unrealized that's saying, well, I'll take it and I'll take the easy breakout trade later. It doesn't work like that. And you know this as well as I do, pal. Another option you have, so to think about why you're making that decision. Another option you have is obviously you don't have to go all in or out, or all in or all out. You can peel some off. So if you kind of plan this trade out, you say, you know what, I don't know if it's going to break out. No one does. If it starts to kind of consolidate and mince around near my high, then I'll take off half. And I'll pull the stop up, I'll de-risk the trade, and I'll see what happens, see if I can get a break. And maybe advanced trading when you add, if it does break out, does something else. So, there are multiple ways of managing this, but I think the kind of the deep answer really is to consider why you're making that decision. And if the decision comes from a place of fear, then there's work to be done. If the decision comes from a genuine observation, then you can put that into your ops and say, well, actually, I think we're consolidating. Now it becomes the edge is gone. I still want to hold a sliver for the break, and so you manage it accordingly. Okay. Final question. Theo says, thanks so much, Mark. This has given me a few roads to go down to develop my edge. You are welcome, Theo. Thank you so much for your feedback. Pal, thank you, ladies and gents. Appreciate your attendance, so to speak, your attention. We're back again next week. Keep the risk managed as always. And yeah, listen, default is no trade. If there's nothing going on, you don't like it, stay out, live to fight another day, protect that capital because opportunities are there and sometimes it's just keeping your powder dry for another day. Hope that's helped, guys. See you next one. Take care. Thank you so much. Bye bye.